and welcome to FT headquarters for our roundtable discussion on the future of portfolio construction and asset allocation. Our aim today is to discuss the inherent problems of the asset management industry, to discover new ways of working and to at least begin to map the shape of the industry's future. Before we start the discussion, if we could go around the table to introduce ourselves, stating name, company, role and the approximate size of assets we are responsible for advising. If we can start with Jan.
My name is Jan Straatman. I'm from Lombard Odier, the CIO for the company. We have approximately, as a group, 200 billion under management. On the institutional side, about 50 billion.
I'm Eric Verleen. I'm Global Chief Investment Officer for Société Générale Private Banking.
I'm Didier Duret. I'm the Chief Investment Officer for ABN AMRO Private Banking. We manage 160 billion euros in private banking business, essentially.
Pascal Blanquet, Chief Investment Officer of Amundi Asset Management, $1.2 trillion of assets.
My name is Daniel Cooney, Head of Investment Solutions Group here in London. Julius Baer is managing just short of 300 billion assets under management purely in private banking, wealth management.
Hello, I'm Bill O'Neill. I'm Head of the Investment Office here in the UK for UBS Wealth Management. I'm part of a 200-member team that is dedicated to wealth clients, private clients, and we manage something in the order of about $2 trillion.
I'm Amin Rajan, Chief Executive of Create Research. We don't manage money, we are a research outfit, so we're in the business of generating new ideas.
There is something in the human psyche, is there not, that leads us to draw up a theory for everything. Was there something inherently attractive about a theory which propagated taking more risk for more reward and led to several Nobel Prize winning submissions and helped some consultants make millions in selling their computerized risk management systems?
We learned at school that the higher the risk, the higher the return, but we, in the last 30 years, low volatility stocks, to give an example, outperformed high volatility stocks. So it's part of, it's to an extent an enigma. And it's a challenge to the theory. The crisis acted as a wake-up call collectively. It's not coming out of the blue. Actually, we all knew that there were challenges to the market efficiency hypothesis, the distribution, the normal distribution of return, the CAPM theory. We knew that there was some misunderstanding or misinterpretation of some elements of the theory. Actually, think of the Markowitz framework, for example. All individuals are supposed to have the same kind of expectations. There were flawed aspects. Diversification, as we defined it in the last 20 years, didn't work when most needed. Doesn't mean that diversification is dead, but what should we diversify? Asset classes or factors, and this kind of things. We spent comfortably 30 years basically trading equities versus bonds. That is the equity risk premium, and we called it allocation actually. And it was comfortable because governmental bonds provided the cushion for the exposure to risky assets. But the fact is that the efficient frontier of governmental bonds has changed, meaning that the utility function of govies has got to be reconsidered. And this opened the field for research moving forward. And there are many other examples. We didn't take fully account of liquidity as the third critical dimension on top of risk and return, managing money.
Professor Amin Rajan, you were using this form of modelling back in the 1970s in the UK civil service. Was it problematic even then to model the macroeconomic equivalent of modern portfolio theory? What conclusions did this lead you to reach about investing?
In fact, we were forced to model what was then called the rational expectations ideas, which came out of University of Chicago, which had a lot of influence on IMF, and UK was borrowing about £3 billion or $3 billion from IMF in those days. However, when you try and model it, and particularly for estimation purpose, what you end up with is an equation which in plain English basically means that the future is not going to be very different from the past. In other words, the past is a perfect guide to the future. And you know, and I know that in the world of investing, past may be a good guide, but it's a very imperfect guide to the future. So when I left the Treasury, what I did was a post-mortem to sort of find out, how those equations were behaving. And what we found was as follows, that, in almost every case where we had made predictions based on the idea of rational expectations, our forecasts were wrong. And on the rare occasion when they were right for wrong reasons. Wrong reasons in the sense that the underlying assumptions we had made about exchange rate or about world price of oil or some of the methodology that we had used, really, they turned out to be faulty, but they helped us on this particular occasion. So from then on, I became very skeptical about the whole idea about rational expectations. And then when I had a chance to write about this in the investment context, I did an article for the 300 Club, and the amount of hate mail that I got was really quite breathtaking for a guy who is totally ordinary and completely unimportant. I couldn't believe, how many people, particularly in the United States, really still believe in modern portfolio theory. And what we found in that particular paper was really that, if you look at empirical evidence, and I'd surveyed something like 140, most prominent articles on modern portfolio theory, and some of them were actually written by the proponents of modern portfolio theory. We found that there was no evidence to support modern portfolio theory. What had really happened was that as the papers were written about modern theory, the markets had taken off. This was in the 1980s. And we had a very long bull run up till about 2007, say. And in that climate, you can make any theory fit the facts. And if you look at the really what has been happening in the field of investment since about 2000, there's everything in that field which suggests that modern portfolio theory is completely irrelevant to today's needs. However, to go back to your very early question, it's a dangerous comfort blanket for people who come out of universities or who really want to have a very sophisticated way of investing.
Well, that's a very strident view from Professor Rajan. I'd like to bring in Didier here, Didier Duret. Perhaps there's a sense in some quarters that that contrary to what Professor Rajan says, there's actually nothing wrong with the theory at all, that the world is imperfect, not the theory, and that we can still use it as a very valuable tool, providing that we know its limitations. What's your feeling on that?
Sure, I think, we all know that what went wrong with the modern portfolio theory, but we still have to come to terms what went wrong with us. Meaning, were we able to really take it and fit in the notion of risk in one number? And I think the problem now is to come to the humble perspective and recognize that risk can be approached with several factors, not only quantitative factors. So don't fall in the trap of quantifying, the reality, but it's more having different sort of sensors able to capture the notion of risk, the quantitative risk, but also the qualitative risk, do stress tests, have multiple approach in order to to capture the complexity. Because in fact, what has really disturbed totally the model is simply that the complexity has created shock, and the reality was not able to withstand these shocks. In particular, the shock of liquidity, or the shock of extreme valuation, or extreme under-evaluation. So this we have to live with, but I'm very happy to see that the asset management world is coming back to the idea that risk is asymmetrical, because after all, this is the first assumption of a private banking for centuries.
And Bill O'Neill, you've worked for several private banks as a long-standing chief investment officer. Were all your asset allocation models generally underlined by the existence of this particular way of looking what's around us in terms of stocks, bonds and other assets?
The clients want guidance from us as wealth managers. They want to know how to allocate their wealth. over the longer, medium to longer term. For us, by the way, that's 5 to 7 years. And I'm talking here about strategic asset allocation. At the end of the day, strategic asset allocation, the big asset calls account for about 80% of the overall experience of a client. TAA and stock selection, 10 each on the other side. And at the end of the day, what we're trying to do here is provide clients with guardrails in terms of their asset allocations over time. And certainly when we look at the world, regardless of what you feel, crisis, pre-crisis, post-crisis, you still need a systematic approach to how you look at asset markets individually and collectively. I don't buy the argument, essentially, that basically the crisis killed diversification. You just had to hang in there and hold your nerve to keep focused on the medium to long term. And at the end of the day, a balanced portfolio in US dollars would present a return of about 6% with volatility of about 8%.
But I've got a little bit of problem before we take away the Nobel Prize from Harry Markowitz to throw away the modern portfolio theory. I think that we have to understand that what he introduced was not just a model, it was much more a concept, and a concept that was developed obviously in a period when most investors across the world, everywhere, were basically investing only in cash and fixed income and only domestically. If there was no, let's say, global coordination in terms of economic and monetary policy, you automatically have low correlation globally. So what he introduced at that point in time made a lot of sense conceptually to create, let's say, a more global portfolio, investing in other building blocks that were low correlated, and hence you have a much better diversified portfolio. And I think those concepts still make a lot of sense. I think the problems that we've learned to experience is that correlation over the last, let's say, 30, 35 years has increased enormously on the basis of, let's say, globalization, the introduction of enormous derivatives which allow us to move very, very quickly in and out and allow, let's say, very big financial institutions to hedge and to arbitrage away every minimal inefficiency that exists along traditional asset classes. And I think we also have to admit that our entire business, our entire industry has been built on, let's say, the modern portfolio theory concepts. And having worked for a lot of institutional clients and have done a lot of ALM studies, for example, I've learned painfully how wrong you usually are after 3 years with all the assumptions that you put in. Usually your ALM study based on your assumptions of correlation, risk and return, and the economic assumptions typically after 3 years, if you look back, are wrong. So your assumption of strategic asset allocation or your risk-free portfolio is typically not as risk-free as you assumed. So I think those are very, very important flaws that exist, not so much related to the concepts that were introduced by Markowitz, but very much because of the fact that our world has changed dramatically. So it's much more, I think, the assumptions and the implementation of those concepts that is the problem, and the fact that we have been quite complacent over the last, let's say, 40, 50, 60 years in terms of how we implement models. What I usually say is that if curiosity killed the cat, then complacency will kill the portfolio manager. And I think we still assume that monetary authorities are right. We still assume that those models are right and quite blindly follow the outcomes. And that, I think, is the biggest problem.